Okay, awesome. Yeah, are there any questions about the other activities besides 3.23 that we need to talk about? All the other activities are once again asking you about cash flow statements. I will show you the answers to some of the other things as well. I'll scroll down it and you can pause it during the YouTube video. They seem to ask about the same things, but there are, in each activity, there's something different and complicated about that specific activity. It may not be worth a lot of marks, but always hone in on the differences between the different activities. I understand. I know these are long activities, and cash flow statement also takes a bit of time to draw up. But hone in on the differences between the different activities. You probably have to draw a cash flow statement in all of them, but then there will be something in the additional information that will change. That's what we should be talking about, because those are the things that are different and could probably stump you in the exams. Because when it comes to the exams, it's going to be same old for 80% of the paper, but there will be 20% in there that we are trying to stump you with, I would say, or it's just a little bit of extra learning or understanding of the subject is needed to get yourself an A, for instance, okay? So keep that in mind. And those types of things are in these activities. You just need to look for it. Look for the difficult part. Look for, if you look at the answers later, look for the differences in the answers. Why does this one have an extra column for something maybe? You know, those types of things. But if there is no other questions about activity 3.24 or 25 and so forth, we will move on to 3.23. I'm going to show you the answers now. Remember, when it comes to cash flow statements, we're going to talk about the answers, where things going, but you also need to memorize, I guess, the actual way a cash flow statement looks. Just like an income statement and a balance sheet, you have to know. You know, you're not going to get like a formula sheet where they tell you exactly how these statements look. You have to know yourself. Okay? Let's take a look at the answers. Once again, I'm not too concerned about the numbers. We all know how to use our calculators. I'm more concerned about why things are here or why things are not here in the first place, right? So when it comes to a cash flow statement, the main thing that we are doing is undoing the principles of what happened in the financial statement. Because in a financial statement, they only care about the action that gives a rise to the income or gives a rise to the expense. That's why we have income received in advance or expense accrued, expense prepaid. Because sometimes the cash is not there, but we still need to recognize the fact that the action took place. If that makes sense. In the year that we are talking about, if the action has taken place, we need to recognize it. It's got nothing really to do with the flow of cash. So if you want to know about the flow of cash and what's actually going on in our bank account, and do we have how liquid are we, you know, in terms of if something goes wrong, do we have enough cash to pay that off quickly? That's the type of thing that we would use a cash flow statement to check. So in a cash flow statement, we are undoing those principles now. We don't care about the action that happens before the expense happens or the action that took place so that we can deserve this income. We only care about the actual flow of the cash. Whether it's for this year, whether it's not for this year, doesn't matter. We are concerned with whether we received the cash or we received proceeds or gave out the cash. Okay, that's what a cash flow statement is. Now, the main principle when looking at the flow of cash between an asset, let's say the debtors control account or the trading stock account, we would assume that if you minus your opening balance from your closing balance, that is the difference or the cash flow that has flowed for the year. Your opening balance minus your closing balance. Okay. In a lot of the instances, other things could have happened, like in the additional information you'll see that you can't just take your opening balance minus your closing balance to get your cash flow. There are other things that will need to be taken into consideration. But a lot of the times, if you take your if there is no additional information, the cash flow would be your opening balance minus your closing balance. Okay. If there is no other information you'll see later, that's all we will be doing to get the cash flow amount. Also, let's have a look at the first part of here. Take note of the headings as cash effects from operating activities, what goes under that? Investing activities and financing activities. Okay, cash effects from those three. Those are your main headings. They will have your totals. After you add this, I personally like to draw thick boxes around the things that are totaling up. There should be one over here, a thick box, as the total is the 155. And over here, there should be a thick box over here, I think, personally. And then this is the total over here. Right? And then you take your total from that, from this one, and that gives you your net change in cash equivalent. Right? And it should all balance it and all balance out. They're giving you this amount, so it should balance to this amount, and they're giving you this 55,000 as well. So it should balance to the 143,000. That's kind of the process you go through, but obviously they would be trying to make it as complicated as possible for you, so it won't be that simple in terms of just taking things out and putting it where they need to be, right? Also, one other thing is interest, very important. Interest is part of your operating profits, right? It should be in here, cash generated from operations. But for the cash flow statement, they want to show interest by itself. It's special, okay? So even though we're going to take it out of the net profit and show it over here, it's just in terms of displaying it in a different place. It's not that the interest hasn't been paid. All we are doing is taking it out of one place and reallocating it so that it has its own line on the cash flow statement. Okay, because it's important for the cash flow statement to know how much interest was actually paid. Okay, so it's not in terms of, yeah, we're going to look at this note so we can get this number. But in terms of the interest, all we're doing is taking the interest out of this amount and giving it its own line over here. Nothing more complicated than that. Okay. Any questions, guys, so far? This is just about the structure and exactly what we need to do when it comes to the cash flow statement. What's the goal? Okay. It's undoing the principles of GARP, because we don't care about the actions, we care about the flow of cash. Let's look at that first note. First thing, very important note, probably the most, in terms of notes, it will probably give you the most marks. Cash generated from your operations. What you need to start this is your net profit before tax. Now this is the different, I would say the difference between this activity and the other ones. Why? Because they are not, they don't give you the net profit before tax. Unfortunately, they're being very difficult about that. If you look through, because that's how I was scouring this whole thing, so I could start my note, but they don't even give you the profit before tax. How are you going to work that out? You need to understand that where do you work out the profit before tax? Where is that actually done? You work it out in an appropriation account. So to get your net profit before tax, you need to quickly do on the sides, or no, actually not on the side, in your workings, you would do a small appropriation account. It doesn't have to be official general ledger account, right? It's just the working that you would need to do. So you can work out your net profit before tax. Let's have a look at that calculation. What goes into the appropriation account? That's what we're testing. Do you know what goes into a appropriation account? Let's have a look. You've got your retained income, your opening and closing balances. Luckily they give that to you. You are working this amount out. The income tax, they give that to you as well. That's the income tax that needs to be paid. And they tell you the dividends, which is the 308 interim dividends plus what the liability is at the end. Why? Because this dividends amount is only concerned with what was declared for the year. Please write that down. Unfortunately, I can't write on this piece of paper. I would have written it in big bold letters. This dividends amount is not the amount of dividends that actually came out of your pocket. When we talk about the appropriation account, we have to put our GARP principal hat back on. Take your cash flow hat off quickly, because what we need is a profit before tax number, which is calculated using GARP principles. So cash flow statement off, take that hat off quickly. put your GARP principles hat back on, and this dividends amount, now that you've got your principal hat back on, your GARP principal hat, is the amount that is declared for the year, because that is the action. As soon as you declare dividends, you need to pay it. Doesn't matter if you have paid it. Remember, for GARP, it doesn't matter if you have paid it. But as soon as the action occurs of you declaring dividends, it means it needs to be paid. Now, how do you get to that 484? Check out the last last bullet point for the additional information. It says interim dividends paid during the year. 308,000 Rand. So that was declared. Great stuff. As well as the liability shareholders for dividends. That actually is what hasn't been paid, right? So you declared 176,000, but it hasn't been paid. But it has been declared, and that's the amount that we need to work out our profit and loss before tax, okay? So once we have this number, right, we have this number, which is our liability plus any dividends that were paid during the year. And we have our opening and we have our closing balances. Now, which side is bigger? This side is bigger, so we put that down. And this is the balancing amount, which is our profit and loss, or profit before tax. 957, that's how we get to the 957. Talk to me about that not making sense. It's the most, I think, the most complicated thing about this example. And they like to do this a lot, unfortunately, where they don't give you the net profit before tax. They like to be evil like that. So if they don't give it to you, you've got to look at your appropriation account. Yes, does somebody want to say something? Go for it.
So if they don't give you net profit, then this is what you do.
Yes.
Is there any way to specifically determine when you have to do that whole GARP principle thing, like when you have to declare? Is there any way to specifically identify? I'm not really 100% on that.
Well, they need to tell you. You need to know that when you're looking at appropriation account, this dividends amount is not in terms of cash flows, it's in terms of GARP principles. And when it comes to GARP principles, it's dependent on the dividends declared, not paid.
Is there any way that you can confuse it? Like if you...
Oh, you should... it will be in the wording. It should just be in the wording. As soon as they say something is declared, that means that the dividends is a liability now, right? And it needs to be taken into consideration. Okay.
That's how we do it.
Yes. Any word of dividends coming out means it needs to be recognized in terms of GARP principles. But when the cash flow statement, we're going to talk about dividends that's actually being paid. We'll talk about that later. But in terms of working out your net profit before tax using your appropriation account, you see the word dividends, it's going to be taken into account because it has been declared. I hope that helps. Okay. There shouldn't be any confusion in terms of working out this dividends amount. There's a difference between this dividends amount and the amount we actually paid. Don't get that confused. But to work out your profit and loss amount, we only need the dividends that has been declared. And in the information or anything like that, you will never get something where something wasn't, they talk about dividends that wasn't declared. It has to be declared. And for GARP, something is declared, it needs to be taken into consideration. That's a liability. Because when you declare something, it's usually in public. So that liability is there. People can sue you now after that if you don't give the dividends. So this appropriation account, dividends amount, is all the amounts that have been declared. And in terms of the additional information in that, they won't try and confuse you. Because you know that when something is declared, it needs to be taken into consideration. Very different when you put our cash flow statement hat on. Because we don't care about things being declared. That doesn't mean money is going anywhere. I can declare something and pay it in 2 years' time. Obviously you can't, you'll get sued. But I'm just giving you as an example. Okay, I hope that makes more sense. There's a difference between dividends paid. When you're working out the appropriation account, we've got our GARP principle hat on, just so that we can work out the profit and loss. Once we have that net profit before tax, let's take our GARP principle hat off and put our cash flow statement hat back on. Okay, this amount over there will also make a little bit more sense when we talk about the dividends paid. Okay, I hope that helps. But no, there won't be any confusion when it comes to what is declared and what is paid. Because you know, to work out a profit and loss, anything that's declared needs to, when it comes to dividends, needs to be put in your appropriation account. The only difference is when cash flow comes into consideration. Now we need to worry about the actual amount that's paid. Okay, and we'll get to that calculation as we go. Right, we need to take out adjustments in respect of depreciation. Why depreciation? Because it's got nothing to do with cash. Our profit and loss has been made smaller by depreciation. We don't want that, because that doesn't mean we have less money in the bank. So add back the depreciation. I hope that makes sense. Right? I'll give you a smaller example. We have 100 Rand in the bank, that's our business. We only have 100 Rand in the bank. We have an asset that needs to be depreciated by 50 Rand. So when we work out our profit, we're only going to have our bottom line. We only have 50 Rand left. But is that true? No, we still got a 100 Rand note in the bank account. We need to add back the depreciation so we can actually see what cash we have. So keep that in mind, guys. There will always be depreciation and you will always have to add it back. This is a staple of cash flow statements. Okay, does that make sense? I hope that does. Depreciation. Now the interest expense. I spoke to you already about interest expense. When it comes to this amount, we are adding it back so that we can just take it out later. It's a visual thing when it comes to the interest. And we take it out there. We are recognizing the fact that when we pay interest, we are losing cash. The only difference is we add it back over here and show it separately. Okay, that's where the marks will come in. Not really for the calculation. The calculation itself obviously gets you the marks. But if you need to show that interest expense needs to be shown on its own in the cash flow statement. So we add it back there and we take it out by itself. Am I speaking too fast, guys? Is that making sense? Interest paid on a cash flow statement just needs to be shown separately. Unlike depreciation, there's a different reasoning for depreciation for adding that back, right? The depreciation is being added back because it's got nothing to do with cash. The interest paid is being added back because it needs to be shown separately. Okay. And we will move on. We don't have a lot of time. Right, once you have that, you added back everything after you worked out your profit and loss amount. If you added back these two, you've got your profit before changes in working capital. Take note of the wording, guys. Operating profit, that's what you work on, before changes in working capital, now for changes in working capital. Let's work it out. I don't like the fact that they don't have thick. You should have a nice thick border over here, because this is a total amount. This over here, it is the total of these three together. Now let's look at the cash effect on the change in working capital. Now remember, the change in working capital is your opening balance minus your closing balance, right? Sometimes kids will get confused with, should it be in brackets or should it not be in brackets? How do you know? You got to think about this logically. For me personally, I think about it logically. The change in stock, as you can see, it has decreased. You got your cash flow statement on now at the moment. Let me just look at the inventories. Yes, okay, so it's gone. You're taking your 720 in the balance sheet and you're minusing your 850. Trading stock has gotten bigger since last year. What does that mean? It means you have spent more money on trading stock. You have given more cash out and you have gotten more trading stock in. That is why we are decreasing the stock amount, because we are getting rid of money for trading stock. That is why it is 129,800 decrease. Talk to me if that doesn't make sense. Change in stock. For all of those, all we're going to do is taking the opening balance minus the closing balance. But you need to know whether to minus the answer or plus the answer. Logically, if we have more stock, it means we spent more money on it. And therefore it is a minus. For change in receivables, there's more than one receivable. You need to go to the additional information. It's the trade debtors. plus the prepaid expense, that's also an asset and it's also working capital. You add those two together. Which side is bigger? The opening balance is bigger than the closing balance. So that means our debtors control has gotten smaller in the year. And because of that, how does our debtors control get smaller? Because people give us cash, right? People give us cash and our debtors controller gets smaller. That is why the 80,000 is a positive, because our debtors control is getting smaller because people are giving us more cash. Cash is king. We have our cash flow statement hat on. 80,000 is more cash coming in, our debtors is getting smaller. We don't mind that our debtors are getting smaller, we don't care about that. We care that we are getting even more money, 80,000 Rand. We're making our debtors control smaller, but we are getting 80,000 Rand. The change in payables, that is your trade creditors and any other asset that is not a dividend or a SARS tax. Have a look at the additional information trade and other creditors comprises of. There could be more things. They could make up things just to check if you're going to add it or not. Okay. And what you would do is definitely add it. The only things, I'll say it again, that's not added to your change in payables is income tax and shareholders for dividends, because you sort that out later. Okay. Everything else should be added when it comes to your opening and closing balance differences. So you have a look at your changes, which side is bigger, which side is smaller. If you add it up, it looks like 2019 is bigger. I mean, the year that you are in. Your closing balance is bigger than your opening balance. As you can see, it's an inflow of cash. It's a positive. What does that mean? It makes sense. It means that your creditors and your liability has gotten bigger over the year, which means you haven't been giving out cash. It's good. You don't care that you owe all these people money, but you have been giving away less cash, and your creditors has been getting bigger. Your liability has been getting bigger because you have not been paying these people, which is great for cash flow statements because we still have the money. That's why it's an increase in cash flow of 43,000. Yeah, we don't pay our debtors. We don't pay our creditors. We have kept the money. That's what this is showing. From our opening balance to our closing balance, our creditors control or our liability has gotten bigger. And for our liability to get bigger, it means we are not paying people with our cash. Does that make sense, guys? Does the logic between why we plus or minus these amounts, does that make sense? I'm hoping it does. When it comes to creditors, if the amount is bigger, it means we haven't been paying our creditors, and it's a positive amount. When it comes to receivables, if our receivables are bigger at the end of the year, it's not a good thing because people haven't been paying us. Remember, if our debtors gets bigger, it means people have been buying things from us on credit and not giving us the cash for it. In terms of stock, if our stock is bigger at the end of the year, it means we are losing cash because we have used our cash to make our stock bigger at the end of the year. So if our stock is bigger at the end of the year, it will be a negative flow of cash. Yeah, and remember, guys, you should have gone and struggled with this before. I shouldn't be teaching cash flow statements. I hope that makes sense, guys. You should have struggled with this, and there should have been a light bulb moment, or if not, we should have struggled with another activity, or what you have struggled with. You know, that's the first thing I'll always ask. Let me look at the activity, or the amount, or the calculation that you have been struggling with, so I can hone in on it, and there isn't a lot of us, there's only 7 of you guys here. I can individually, 2 minutes, what's the biggest problem for you, and we can work it out together. Okay, it's just so you can get the most out of our sessions together. Otherwise, we'll just be going from the beginning to the end of one activity, not really looking at all the extra difficult things from the other activities, because I'd rather jump around, look at the difficult things from each one. Because if I start another activity, then it's going to be the same things, or most of the stuff, you know, with one thing that's changed. So I'd rather get it from you, what exactly, yes. Yes, definitely. We won't do that. We're still learning. There's still things to learn. But closer to the June exams, maybe 2 weeks You can do 2 weeks of sessions where we're just looking at papers. Okay, the last 2 weeks before June exams. But then at that time, we'll give you maybe some papers. And I mean, these only 30 minutes, it's 3-hour papers. We only got 30 minutes together. So you must come with questions, you know? Come with your problems. So we can talk about that rather than just starting from the beginning to the end. For this control test, I don't think there will be mock exam papers, but definitely for June. But please come armed with questions. That's the most effective way to do it. Let's look at this dividends paid before we end. We are now going to quickly look at, so we worked out there's the amount cash generated from operations after doing all of this. You finally have this amount over here. Now the interest paid, you know, we've taken it out in the note, add it back in. This is the amount that you actually paid. You add it back in by minusing it. I know it's weird. Dividends paid, 436. It's not the exact same number as the amount that's in the financial statements or the amount that's in the appropriation account. See, it's not exactly the same because you need to, usually when it comes to working out the difference of shareholders for dividends, usually it's still the opening balance minus the closing balance. But because there is an interim dividend that was paid, there is an extra bit that needs to be added. That needs to be added back before you do your changes in opening and closing balance. See, on the financial statements, you need to first add everything that was declared. The 308,000 was paid also, so that doesn't show on the liability. So you add it back and then take off your opening and closing balances. That's how you would get your dividends paid. This is the amount declared, and then the balance at the beginning of the year, and you add back the balance at the end of the year. And this will give you your dividends paid. This is the amount that will be on the cash flow statement. Now when it comes to income tax, it's exactly the same as dividends. Now if there was an amount that was paid during the year for tax, it would once again be added back to the liability of 450. But the income tax is a little bit easier. There hasn't been interim, remember we talked about interim payments of income tax. There wasn't any of those. So the liability, the income statement at the amount at the end is the liability. And then we would once again add the balance. Oh, very different, guys. Oh, there is something different about number 4. You see, there's always a little bit different. If you have a look at the SARS opening balance, take that to tricky here. It's actually an amount that SARS owes you. So usually the opening balance would be in brackets because that's the amount you would owe SARS, and during the year, that opening balance, you would have to pay that off using cash. Right? But in this instance, and take a look at the actual question. The balance at the beginning of the year is an asset balance, meaning SARS owed us money. Very unlikely in the real life, but SARS owes us money from the opening balance. So during the year, to get that opening balance off, SARS will give us cash. You owe us money. So that's why it is a positive. Usually it's a negative, right? Usually it is a negative. Just like the dividends. This time it's positive because for some reason SARS owes us money. And then the balance at the end of the year is always positive, as that represents an amount of cash that we didn't pay. Remember the balance at the end of the year for income tax liability? No, negative. Positive inflow of cash is normal. The brackets are for outflows of cash. When we pay dividends, it's an outflow of cash. When we pay tax, it's an outflow of cash. Okay? Positive means inflow of cash. And this 2.2, which is the beginning of the year, is an asset from SARS. We are going to get this money back because they owe us. And at the end of the year, it's a positive at the end of the year, the liability, because it shows that we have not paid the 2,400 Rand. We have not paid the 2,400 Rand. That's why it is a positive, because we haven't forked over the cash to settle this liability. Just like at the end of the year, we add back the balance at the end of the year, because that's the shareholders for dividends liability, and it shows that we have not paid the 176,000. At the beginning of the year, it goes in brackets because we will have to pay that dividends will be paid off in the year. It's our opening balance. Before we can even talk about more dividends, that opening balance will be paid off. That's why it's in brackets. The opening balance is in brackets. The closing balance is a positive. But you have to think of it logically. That's the best way to do it. Oh, and we are out of time, guys. Guys, when you one other thing, let me just quickly go back up to the cash flow statement. Let's talk about the purchase of asset. 240,000 rand. Where did they get that? How did they get that? Right? This is supposed to be 240,000. I don't know why. Why is it 250? It's weird. Anyway, the carrying value. So you're doing your fixed assets. You want to find out the purchase amount. Remember, this is the amount that you're actually working to. The amount that you used, the money that was used to buy an asset, right? Because you are only concerned with the outflow of cash. Does that make sense? You are only concerned with cash outflow. And that happens when you bought this vehicle, right? So you want to know what the additions is more than anything. You're taking your carrying value be at the beginning of the year, less the asset disposal of 85,000. That would be your cost minus accumulated depreciation. And then the depreciation for the year, they tell you as well, is 56,000. And they tell you what the carrying value at the end of the year is. You see, you're working your way back to the 240,000, not 250. I don't know why it's the 250. Should be 240. But this is the amount that you're looking for, okay? These amounts are given to you as well. I just don't want you to think that you need to work out the carrying value at the end of the year, because it's not about that. The principle of what you're doing in the cash flow statement is all about what actual cash is leaving us. And the actual cash that is leaving us isn't the asset disposal or depreciation. It's the actual money or the cost price that we paid for the vehicle, the actual addition to vehicles. Okay, I'm not going to go through the calculation, but our time is up. Guys, please go through as many of these activities. I'm telling you, when it comes to cash flow statements, it's all about practice, because you're thinking a little bit differently, you know what I mean? So you have to practice when it comes to this. Okay, next week we're going to be looking at something completely different again. So have a look at these cash flow statements, because this is the last time we're going to talk about it for a while. But if you want to talk about some specific question next week, we will hone in on that quickly before moving on to the new activities. Okay. Other than that, guys, you can have an awesome weekend. I will see you.